Not yet.
Good morning, and thank you for joining us. I'm Eric Uhlfelder, founder of Global Investment Report. Today's uncertainty and volatility are a reminder of the import of effective operational due diligence to help managers handle stress, especially when it's elevated. Such periods are becoming increasingly commonplace. Since 2020 alone, we've seen three distinct shocks. Effective ODD ensures processes are in place that can help preserve capital and reputation. This is accomplished through the review of many operational facets, including counterparty risks, valuations, and clear margin and leverage limits. That's why today we're moderating this panel on operational due diligence. Our webinar series is a product of my annual Global Hedge Fund survey and of the 50 most consistent managers. And next month, I'll issue my 22nd annual survey, which you'll be able to see on LinkedIn. For those not familiar with my report, I've been tracking hedge funds for more than 2 decades for the Financial Times, the Wall Street Journal, Barron's, Institutional Investor, and SALT. And since 2020, I've been producing this survey under my own banner, Global Investment Report, with the sole purpose of identifying the handful of funds that deliver on the promise of active management. Some of the key takeaways from this year's survey that I can share now: trailing 5-year annualized returns of these 50 funds through 2024 nearly matched the market, but with far less volatility and limited market correlation. Their consistency is further borne out by 2 remarkable facets. 85% made the jump from last year's survey, and their average age is greater than 16 years. And through the first quarter, these funds collectively made money. Helping me moderate today's event are Niziol, former head of product management and CMO at Rothschild & Company, and Linus Nilsson, founder of the alternative database Nielsen Hedge and a systematic trader. Feel free to submit questions in the comments section of the invite post. And now I'm pleased to introduce our panel. Olga Romanova is co-founder and head of operational due diligence at A&C Advisors. Matthew Stiling is a senior ODD analyst at Investcorp-Tages, and Nadia Salih is a senior due diligence analyst at Kedge Capital. Before we start the questions, panelists will say a few words about their work. Let's start with you, Olga.
Thank you so much for the introduction, and I'm happy to be part of this esteemed panel. I worked in ODD for almost 20 years. I've been through many ups and downs and significant events in the industry. I worked for a couple of larger allocators, and I moved to boutique side until recently joining A&C Advisors. A&C provides directorship services. We also provide corporate services in the US, and I am helping them with outsourced operational due diligence. We cover a very wide range of assets. We can do due diligence on hedge funds, private equity, private credit, and also digital asset managers.
Thank you. Matthew?
Hi, good morning, everyone. I'm Matt Stiling, a senior ODD analyst at Investcorp-Tages. We are a joint venture between Investcorp and Tages, where we predominantly focus on multi-manager fund-of-fund portfolios with a background in seeding from both sides of the JV. We also host a UCITS platform, as well as our newly found business in our internal manager platform. My background has been actually pretty much 50-50 now across operations and ODD. So I started off as a hedge fund accountant for a fund administrator. I've worked in the operations space across several credit managers before moving on to ODD, where I worked alongside Nadia at Kedge, and after that joined Tages to work on more on their seeding side of their business.
Thank you. Nadia?
Hi, I'm Nadia Salih, and I've been working in the financial services industry for approximately the last 20 years now, and specializing on the hedge fund side for the last 18 years. Pretty much started out in a quant fund quant hedge fund covering operations and fund accounting. So sort of those early years were spent understanding sort of the back office of a hedge fund. And then I moved on to the investor side around 2012, where I started to perform operational due diligence. And I've been on that side ever since. Been at Kedge Capital for the last 6.5 years now. And the focus there is investing only in hedge funds. The fund itself has a large backing from a family office, but also manages capital for external investors. And I'm happy to be on the panel today to discuss all things ODD with Matt and Olga.
Well, we're all happy to have all you with us. Thank you. Let's start off the first question pertaining to the problems that we're all confronting. And I wanted to look at my survey as a source for that question, because right now I'm consolidating my first quarter numbers. Remember, these 50 funds were selected based on performance through 24. So we look at what's going to be happening throughout the year. And right now I have about 80% of the first quarter numbers in, and they're slightly positive, but we have 3 funds that are down more than 20%. And they're billion-dollar funds or larger, hedged equity, event-driven and distressed, but they have all a long, impressive history of consistency. And this performance this quarter so far is very uncharacteristic of them. So I just wanted to start off this with a theoretical about if you were starting to look at funds like these who have a great track record, good pedigree, and suddenly saw this fall off, what would you start to look at in terms of your operational due diligence? And feel free to stray into IDD if you feel inclined. Olga, if you could start us off.
Sure. From my perspective, there are several issues perhaps to look at. One, the investors or allocators really need to know what the redemption terms are. When you start seeing drops like this, do they know what the provisions are for gating, for example, how many managers are going to gate redemptions, if it's a discretionary gate or if it will be triggered automatically, what the cleanup provisions are, and if it's possible to even suspend redemptions. Just going back maybe almost 20 years ago, when Lehman Brothers collapsed, I saw a very unusual provision in the documents which said that the fund could gate redemptions if redemption requests exceeded 20%, and they could pay up to 20%. So they paid 5%, which was a bit of a surprise for the investors, but they said, well, we would rather pay 5% than suspend redemptions. So yes, reading the documents is always important. And then I think it's obviously, it might cause problems with valuation depending on what the fund holds. It's also worth considering if there will be a spike in trading volumes, if the administrator is able to cope with the volume of trading. If it's a smaller provider, can they handle so many transactions? Can the operations team handle so many transactions per day? I think events like this throw up a lot of issues that usually don't come across our desks. So it's good to stay on our toes.
Very good. Thank you. Matthew?
Thanks. So, I mean, the way that I would look at this is I'd break it down into a couple of different steps. So I'd probably start off looking at what the driver was for the current performance. From an ODD perspective, that might be along the lines of, has there been, is it more on a macro level, or do we need to drill down to the actual manager themselves? And if that's the case, then we'll start to look at, is there the potential for style drift within the strategy? Is that caused by maybe staff turnover internally? Maybe, you know, you've just lost your preferred shorting analyst, for example. And then we try to drill that down into the risk management process as well. How are drawdowns managed? Again, as Olga pointed out, obviously liquidity terms are quite important to that. So looking at the match between asset class and liquidity terms for us would be quite important in that regard. But also actually just to look down into how the drawdown mechanism works, for that risk manager to be able to step in and manage the situation accordingly. So that would be looking at the current situation as it stands. We would then take a step back and review the prior track record as well. So we would look for any historical trends, see if any of those situations have occurred historically where we've been able to see where they've been able to work out of, and how, say, for example, the risk management process would have come in to actually make sure that that was watertight and how that was managed. Obviously, what we are conscious of post-event is AUM decline. AUM decline can lead on to other factors. Staff turnover is normally one of them. Obviously, fee revenue, if you don't have the fee revenue coming in from your AUM, that may lead to staff turnover. Staff turnover has further cultural impacts and so forth, and it becomes almost a bit of a snowball effect. So ultimately, in those kind of situations, we may even take a step back, actually, and just see how things pan out for a couple of months. It really depends on what the driver is for that performance, especially in the macro landscape.
Well, I think that's an excellent point, because this is such an unusual time that was driven almost unilaterally that it could be that many of them have already recovered, unless they started to move their portfolio around already in response, and then they keep on falling behind. Nadia, would you like to add anything to this?
I would say to Matt's point, I'm totally in agreement as well that the first step, which I think something our investment team would be looking at, is what is the actual driver of that volatility. That would definitely be the starting point. And then I think if we were then to be past that, to look at further from an ODD standpoint, we might want to understand, like, for example, is it a concentrated book in terms of the strategy, and is that potentially going to lead to more volatility in the future? Are they potentially high users of leverage? What could the potential impact of that be with respect to like margin calls and sufficient cash to meet those margin calls? Potential impact on ISDA agreements as well, impact of any NAV triggers being hit. Just sort of understanding that whole treasury piece as well, and sort of how that kind of PB relationships are managed as well. And as Matt and both Olga talked to as well, just the general kind of governance around the risk management framework. And also to their points as well around the AUM and potential staff turnover, what that may potentially mean for the viability of the business as well, depending on the stage of the business and the size of the business, how drops in AUM like that could potentially also impact working capital and break-even points, for example. So it sort of very much depends on the size and the stage of the business and where they're at. Numerous different factors, but I think that starting point for us would definitely be the investment team sort of trying to understand the driver of that volatility in relation to the investment strategy.
Very good. And the knock-on effects are always the unknown. So I appreciate that. And that leads me just to a quick follow-up, if you folks can look at it. How does this particular event differ from what we saw in 2022, when interest rates and inflation were big issues, and to 2020 when the pandemic hit? Is there any material difference in the way you look at ODD and what you have to consider in the aftermath of these shocks? Olga?
Not significantly. It's trying to predict the unpredictable. We don't know yet what the consequences are, so it's being vigilant, speaking with the managers, staying in touch with the operational personnel, making sure that we are aware of what's happening in the business.
Matthew?
So actually, I think if you look at the period of 2020 to 2022, we have quite an interesting situation, right? We're coming out of lockdown. Sorry, we're going into lockdown. Apologies. Let's take, I don't know, TMT, long short equity, for example. Returns go sky high as a result of the function of that industry and what was going on in lockdown. We see record returns. We go into 2021. There's a level of uncertainty around kind of government policy. We start to see muted returns. And then come 2020, we start to see the inflation narrative kick in. So what we're seeing now is actually we're seeing a lot of rotation away from that particular strategy at a time where earnings are potentially coming in strong because of the prior macro situation. So actually what that proved is that it was actually a very difficult time for managers to manage their gross and net exposure. So what we actually saw is when there was the rotation out of the sector, but yet managers had ramped up their gross because 2021 returns were lackluster. They got caught on both sides of that. So I would say the difference in this example is that it was protracted over a number of years, whereas the examples we're seeing now are over a much more short-term basis as vol increases.
Very good. Nadia, anything to add?
Don't think I have much more to add to that, other than we're just also in a position of waiting and seeing sort of how this plays out. And I think, It's just a question of continuously monitoring the portfolio, and as and when we feel we need to ask certain questions or we need to drill into more detail, we will then take those steps. But for now, I think it is very much sort of monitoring as the days and weeks go by.
And this is similar to what you folks did in 20 and 22, it sounds like, as well at Kedge.
Yeah.
Okay,
Yeah.
Linus is going to bring the next question here.
So I've been fortuitous enough to work for a number of allocators, and sometimes operational due diligence has been more or less an afterthought, and sometimes it's been sort of belt and suspenders. We had last time I worked for an allocator, we had at least 2 layers of operational due diligence. So it's definitely something that's become much more in focus. But I would like to focus on the things that you see that makes a fund or a strategy utterly uninvestable from a operational due diligence perspective. Sometimes you dig down into a manager, you do a background check, something horrendous comes back, or you just find a structure that isn't sort of really compatible with sort of good investment best practices. I'm gonna go for the end. Matthew, would you like to start?
Absolutely. So, I mean, in the OD world, obviously there are big no-nos that we look at. Be that the investment team handling cash, for example, or maybe there's I would say a lack of independence in valuation processes, for example. These are kind of the typical day-to-day ODD red herrings, so to speak. I think one of the ones I've become more conscious of, and an example without naming names, was I visited a manager who, after asking some very basic questions to the COO, was unable to answer relatively easy accountancy questions. Now, this person was also this fund CRO. So as you can imagine, if this person really doesn't have that kind of level of detail to be able to look at their basic fund accounting processes, then they probably don't have the ability to do so at the risk management side either. Lo and behold, we actually vetoed that investment. We walked away from it on the basis that we didn't think that the C-suite was strong enough to conduct the role that they were brought on to do. So we walked away. Now, go 12 months further down the line, that manager blew through the NAV drawdown trigger on its seed agreement with their respective seeder and came to us and asked for acceleration capital. I think we were very clear in our opinion, and we asked if the COO was still with the firm. The answer was yes. So we said thank you, but no thank you. But I think what this highlights is the importance of the COO role, especially irrespective of the size actually of the manager. There is a lot of emphasis put on that C-suite level role. So that can be broken down to CRO, CCO, CTO. But if you don't have the right people at the helm to manage those operational risks, or even the oversight of those operational risks, that's really kind of where the buck ends, so to speak. So I think that's something I've been very conscious of as we see, the hunt for talent, so to speak, within the industry, especially given that's becoming more and more difficult at the moment.
So we once had a fund that invested in a cash manager that turned out to be a fraudulent cash manager. So I think that point about sort of having sort of all balances on the treasury side, that's extremely important. Nadia, you mentioned that that you had a background in treasury, so maybe you would like to catch on there.
No, I don't have a background in treasury.
Sorry. Sorry.
But I can give an example of something interesting that I'd come across in my career when looking at one manager where it sort of taught me the importance of actually looking at fund structures, which I think is quite a key part of the ODD process. So whenever I'm looking at a new fund, I've got my fund structure diagram out, and I'm making sure I know what all the entities are and the governance around those entities, because it was actually in a liquid structure that I was looking at. I mean, we don't look at liquid structures at Kedge. We're predominantly invested in hedge funds. But in this particular model, there was multiple layers. So there was a layer where investors were coming in, and there was, one fund that had come through, and they'd go through to like a holding fund. And basically at that top level, it was based in the US, the jurisdiction, and the governance piece around that in terms of the auditors and administrators were well established, top 4 players. That was all very sound operationally. But if you were to then look through that legal structure and understand where those underlying assets were held, they were actually held through SVPs in a different jurisdiction. So as you followed through to these various SVPs that were held ultimately by this top layer fund, you began to realize that at that level where those assets were held, the auditor and the administrator are actually different to the auditor and administrator of the actual main fund that the investors were going into. But actually, ultimately, the valuation of that main fund the investors were going into was determined by these underlying assets. And as we dug further and further into this, these names of this auditor and this local administrator are actually local names that we hadn't really heard of. Then it got more interesting because actually the audit firm itself was a smaller firm whereby the CIO of this manager that we were looking at had a relationship where he had previously worked with this person that owned this audit firm. So there were just numerous kind of conflicts of interest and governance issues in this structure. And mainly for us, it was the lack of disclosure and transparency. And as we were talking to this manager, that they weren't telling us about this setup. And the more and more we were finding out about it, the more and more we were realizing that there were a number of conflicts when we were looking right down to the bottom of that end asset that we were ultimately owning and what the governance framework was around that. So that really did teach me early on the importance of structures and understanding the flow through down to where these actual assets are actually held and valued. So that's quite an interesting one, actually.
All right, thanks for that. Olga, have you encountered sort of anything sort of even worse than what Matthew and Nadia sort of mentioned? So.
Probably, but I did come across very similar cases to both Matt and Nadia. I'm sure there are different managers from various descriptions, but very similar issues. For one, I had significant concerns about the operations personnel, and we waited until a proper COO was appointed. In another case, there was an SPV where the operations person was siphoning off the money into his own account. But I also wanted to highlight that it's important to question what other people are doing. So for me, the argument that, oh, somebody else approved this for another due diligence is never really a valid point. We've all been through Madoff. We know it doesn't work. And now we've had FTX, which again was approved by ODD teams and for really no reason to approve it. So I've come across several issues in different funds. One was a large manager which had a qualified audit opinion, which for valuation reasons, we vetoed it. We had to explain it several times to the investment team why it wasn't appropriate to accept it. And the IDD team was very grateful to us a couple of years later on when there was a big scandal and they avoided significant losses. And we also had a case recently where I was working with a manager and the administrator and the sub-administrator, and I was asking questions one after another. And eventually I found out that the administrator was accepting snapshots from the manager to value pretty much the entire portfolio. And that fund has gone through several DDs and nobody was able to dig deep enough to find out. So yeah, it's just another reminder to to continue digging.
All right, thanks for that. And Anna, over to you.
So I think that you touched a lot about governance issue and importance of that. So I want to a little bit follow up on this with potential real life examples, but talk about the culture of the company. Do you actually evaluate culture of the company from your due diligence perspective? How important it is to you? And also, do you have examples, and I'm not sure if you do, that the culture of the company, and obviously governance, which is obvious, but also the culture of the company was a really key factor for you to either approve or not approve certain managers? And Matt, I'm going to start with you.
Sure thing. Apologies, I'm going to reference lockdown again, but that was quite a significant learning point for us when we were conducting ODD. More because ultimately, as an industry, we are a people-based industry. We rely heavily on relationships, and what we tended to find was that actually in a post-lockdown world, during lockdown and post-lockdown, where everyone is maybe starting to work from home, there's an element of trust that's required a lot more. So on that basis, we would expect the same level of trust to us as investors. That normally is around transparency. Normally, when we look at transparency at the top level, so when we talk about tone from the top, with regards to senior management and how they disseminate information throughout their firm, we'd also take that same kind of rationale to how they communicate with us as well. So actually, it's quite telling how culture can impact actually your relationship as an investor with that underlying manager. And there are basic tests around this. I'm not going to give you all the tricks of the trade, but when we look at this from an ODD perspective, we'll look at things like tone at the top in terms of, do senior management comply with compliance training or phishing tests and so on. Just little basic tips like that actually lead us to get an idea of the picture of how seriously those individuals take the cultural aspects of their business, because ultimately that will then reflect in how they associate with risk management as well, for example. So that's definitely one of the big tests that we were looking at. And I think, to be quite frank, this is why we're big advocates of going on site to see all of our managers still, because we do believe that a lot of that trust aspects and understanding the culture of the firm is literally by talking to somebody in a room and seeing how they react. A lot of the time we ask quite difficult questions. That's also a leading telltale sign into how they would react in those circumstances.
Thank you. Olga, do you have anything to add?
I agree with what Matt said. It's culture is crucial to us building trust relationship with the manager. You can have controls in place, and we definitely check that they do, but ultimately there's still an element of trust involved in these allocations, and you can't get away with it. What I wanted to mention is I have one example that I've seen very early in my career. I was looking at the fund, and they were very, very arrogant, made me feel very uncomfortable how they were handling it. And they were the first ones to go down in when things started to collapse, just because they haven't read through the counterparty agreements. They thought, well, we have the best terms, and no, it didn't work that way, and they couldn't handle it. So for me, if I see similar levels of arrogance, I'll probably walk away. And there's another point is sometimes it's little things that break that trust over time. You make an assessment to make an allocation, and you approve the manager, and you speak with them quarterly, annually, and so on. And you start to notice that what they tell you doesn't quite add up over time. Sometimes it becomes very obvious that they're just telling you what you want to hear. So when you get to that point, the only decision really is to redeem and walk away, even though there are no red lines, there's nothing that serious that's going on, but the trust is damaged because they're just trying to make things better than they really are, even though they're not fraudulent or they're not big lies, they're little lies, but it's still very important. And that's just part of the culture that they're willing to bend the rules. And
I always remember one manager who was telling me that in our industry, you always have to be humble, because if you're not, the market will humble you very quickly. And that's exactly what's going on. Nadia, anything to add?
I pretty much echo a lot of what Matt and Olga have said. But what I would say is that I think we also very much value meeting people on site, and we feel that we definitely get a lot more out of people if we can meet with them, particularly when we're trying to understand the culture of a firm. But I think during the initial due diligence, it's probably a bit easier to kind of understand the governance and the kind of frameworks there and get comfortable, because I think with culture, you sort of need a bit more time to really understand the culture of the business, and it sort of evolves. So as we're speaking to managers, we continuously, like on a 3-year cycle, once we're invested, we meet again and we go on site and we meet everyone face to face, and we sort of re-underwrite the investment, understand how the business has evolved and sort of how that may have impacted the culture. But it's kind of those relationships, how they form over time, you get a better idea of what the culture is. And one thing that's come to my attention in recent sort of months is there are also cultural differences. So sometimes we think that a manager might be maybe perhaps a bit difficult or not what we're used to relative to other managers, but I think we also need to put it into context of the jurisdiction that the manager's in and the culture. There's quite a broad range of cultures and behaviors, and what might be unusual to one person could be the norm to another. So again, that's just a learning process to understand different people communicate differently. So that's something that's definitely also something we need to consider as well.
That's actually leads me to another question I have for you. We obviously talk a lot, and people think about initial due diligence, but obviously, I don't think you would disagree with me that follow-up due diligence is extremely important, especially you invest in the manager. From your perspective, what's appropriate in terms of the frequency of follow-up due diligence on the managers that you already have in your portfolio? And then, since we are talking a lot about examples, do you have an example that your follow-up due diligence was quite surprising for you, that you actually discovered some, could be culture, as Nadia mentioned, or but some issues that you did not notice or did not recognize in your initial due diligence? I'm going to start with Nadia here.
Okay, sure. So I think in terms of follow-ups, it probably very much depends on the risk profile of a manager. So whenever we do our initial due diligence, we have a rating methodology where we assign managers like an amber or a green. They wouldn't be red if we're going to invest initially, but that's kind of the rating schedule. And so if we have been monitoring a manager and they happen to be on amber, they're going to be more frequently monitored than, say, a green manager, for example. We have a formal monitoring program on an annual basis where all managers in the portfolio are monitored and an actual report is written up with the results of all of our findings of that review. And as I said earlier, like every 3 years, we do like a full re-underwrite of the investment, and we perform an on-site visit and we reperform the RAG rating again. And the primary reason for that is because businesses definitely do evolve over time. And so when we're writing our initial review, we may have a viewpoint on that business in terms of what the strengths of that business are, where the areas are for improvement. And that business could be in a completely different place in 3 years, whereby that profile has actually changed. And that's what the driver is for this new report write-up. And so that's kind of how we look at it. And I would say more on an informal basis, there are certain documents, whether it be PPMs, Form ADVs, etc., that are updated throughout the year. And those kind of documents we're looking at as they're coming out to make sure that we're keeping on top of those changes. And if we have any questions on those, then we can go directly to the managers, make sure we understand, rather than waiting for the formal annual review. And similarly, if there's been sort of any changes to the manager's business, whether it be change to personnel, any kind of major operational changes, we're expecting to be informed of those as well, and talking at the point that that's occurring with the managers directly. Again, that's not something we'd be waiting to talk about, in a year's time. We want to talk about those as they're occurring so that we can make a decision as to whether or not we're comfortable with those kind of changes. So that's kind of what our monitoring program looks like at Kedge.
Thank you. Olga?
Yes, I agree with very regular touch points with the managers. I'm currently working as an outsourced auditing provider, so I don't have any portfolio that I look after. When I did, we had annual or every 18 months revisits. To my clients, I do recommend keeping in touch on the operational side, and I'm happy to do it for them. It really depends, like Nadia said, it depends on the risk assessment. For some of the managers, it's worth staying in touch with them quarterly almost. I work with a lot of digital asset managers, and that's definitely a quarterly monitoring program, because just so much changes. They're very small, they're developing very quickly. So quarterly catch-ups definitely justified. I strongly believe in on-site visits. So from my perspective, the best practice would be to visit annually, if not possible every 2 years. And I agree with Nadia. Full underwriting is very healthy, and it's good, if possible, it's good to have rotation. You have one analyst looking at it 1 year and then somebody else doing the reassessment later on. If you wanted an example of where like revisiting the manager brought up issues, I have a good one actually. I was working on a new launch. I was literally day one investment from the funds that I was working for. It looked good. We had concerns and we put them on very tight monitoring. When I revisited them, I think it was 9 months or 12 months. By then, they've incurred 1.5 million of organizational costs. And from just personal relationships, it was very obvious that the COO would do as he's told by the CIO. It was very obvious during the on-site meeting. So I quickly changed my opinion and we replaced the redemption. It wasn't obvious at the beginning because you couldn't evaluate those dynamics, and they didn't tell us about significant costs that they were going to incur. So yes, it's a good example of when it's actually worth doing very regular catch-ups.
Thank you, Olga. Matt, do you have anything to add?
Yeah, I mean, I very much agree with both Nadia and Olga in terms of the regular monitoring based around a risk-based approach alongside your normal monitoring process. So we'll skip straight to the horror story. So yeah, I've definitely come across events that have triggered further due diligence. So for example, one of our underlying managers had a regulatory fine. So that led us to doing a little bit more due diligence, if you like. It then transpired that the COO was constantly ill and couldn't make the call to explain how this regulatory fine had come about. It was actually just on position reporting to their regulator, which they'd missed. But then we started to notice that the COO wasn't attending calls. So we dug a little bit deeper. We then started to, we then saw a new head of corporate governance brought into the manager, which started to set alarm bells. So we started to ask a bit more background on that individual. Turned out it was the spouse of the PM because they were worried that the PM was underperforming. And again, it all snowballed. And ultimately, it was that lack of transparency throughout the whole process that actually led us to put in a automatic redemption straight away. Just through sheer lack of transparency, we could see that there was a cultural issue within the firm. We could see that that was affecting individuals within the firm and their processes. So yeah, we acted on that one I think we turned around that whole process in about a week and a half.
Wow. I mean, as Nadia said, I think culture you guys discovered during the follow-up, the diligence, more so than initial due diligence. All right, thank you so much.
Possibly so, yeah.
I'm going to turn to Linus.
So this question might be a little bit counterfactual, right? Because all of you are obviously supremely competent when it comes to making operational due diligence. So what kind of mistakes would the allocators do if they wouldn't have had an ODD process in place? What would you see? What would you see completely different risk appetite from the allocators? Or would you just see sort of simply more frauds or operational mistakes or weird setups? Matthew, you're nodding very aggressively here, so I'm going to let you speak first again. So.
Absolutely. So I think one of the biggest issues, and I think we've almost touched on it a little bit previously, is talking about the importance of going on site. And the reason I bring this up is because the SBAI conducted a survey last year of the ODD community, and it transpired that about 2/5 of the ODD community felt they didn't have enough time to complete their work. So what does that mean? It means we start, focusing more on where we think the risk is and focusing more on those particular areas as a community. So that might stop us from doing things that we should be doing in the normal course of business. One of those going on site and reviewing managers. That may involve not reading a whole compliance manual, for example. So what we may find is that actually what they're practicing versus what they're preaching are completely different. I think the outcome of that is probably more likely higher regulatory fines or a higher volume of regulatory fines. So that's just one example. Again, not reviewing third-party service providers as well, going back to Nadia's example earlier by drilling down through the governance and the fund structure. There are a lot of third-party service providers that are coming through that we may not have had contact with before. So we really need to go and we can't just rely on the COO to have that oversight role. We then actually have to take another step further ourselves and start working on ODD on those service providers as well. So, and these are all things that build up to the bigger picture that are very costly in terms of time and through expenses directly as well. So as a result of that, you can see that these are quite fundamental things, but they're easy to miss because ultimately time is a factor, money is a factor. So I'll just leave that there.
So, Olga, you mentioned that you do a lot of digital hedge funds. You mentioned FTX. Would you see more of that type of mistakes from the allocator community if they wouldn't have had a solid operational due diligence process in place?
I believe so. I've been doing ODD for 20 years. I'm a firm believer in the value that it brings. And as we spoke when we were talking about this webinar, you can't diversify operational risk. You may be forgiven for underperformance, or you can explain it away. But if there is a fraud within your portfolio, it's a huge reputational risk, and it's very difficult to recover from it. So I'm not sure how you can justify not doing due diligence. And within digital assets, it's still developing. For digital asset space, I would say you probably need to work with specialists that know that ecosystem and the service providers and so on, because it's so different from traditional hedge funds. And that's definitely where we bring the biggest value, because we're helping the managers build institutional level practices, and we slowly making them safer and safer, taking baby steps. But I can definitely see a lot of value brought by the ODD teams.
Thanks, Olga. Nadia, have you sort of encountered anything where you sort of have to stop the allocators from making a huge mistake, or maybe you're working in such a firm where that never happens? So.
No, I was going to say I pretty much agree with a lot of what Matt and Olga have been saying, and I think the time constraint issue is quite an important one in ODD teams, because often they don't have the full resource, or they have quite a large portfolio that they're trying to get through. And so there's a big part of the ODD process that is indeed standardized. But one of the problems is that not all hedge funds are the same. And so you really do need to take a step back from that standardization and that kind of some of those topics that you're kind of looking at, and actually look at the specific risks of the businesses that you're actually looking at. Mm-hmm. So I think it's having the time to take a step back and sort of say, what is it that are the key risks that are specific to this business, and just sort of make sure that you're actually asking the right questions. And I think a second part of that, in terms of also having the time, is that there's a number of different topics that come to light every so few years in the ODD community, like new topics, whether it be AI or pass-through fees. And at that point, you sort of need to it's a whole new education process. You need to get up to date with what kind of questions you need to be asking, what best practices look like. You're constantly sort of reevaluating your process. So I think that's quite a good, quite an important part of being a strong ODD practitioner. And I think the final thing I'll say on it as well is, I think to my point earlier when I was talking about looking at structures and sort of governance as well, I think don't underestimate also reviewing the financial statements, because I find that there's a lot of good information in the notes there. And I think some people just sort of rely on the OM. And I think you actually need to look at the OM in conjunction with the financial statements, because they give you quite a practical overview of how that fund is run. And sometimes you discover there's other entities that haven't been disclosed because they're more current, the financial statements, relative sometimes to the OM, depending on when it was last reviewed. Mm-hmm. You find out more about the fund. And so you're kind of getting a very clear picture using those two documents together of actually how is this fund operating in practice. So those would be kind of some of the key areas that I think would be important for people on the ODD side to focus on.
Thank you very much. You mentioned pass-through, and I think that's sort of a very good segue to Anna.
So I have actually a quite specific question, and to a little bit more complex structures like multi-strategy funds that comes from, with its own challenges. So my question is, how do you approach the review of the pass-through fees, the leverage and different sorts of leverages in these funds? And I'm going to start with Nadia, since she already mentioned about pass-through. What is your evaluation? How do you evaluate those managers with multi-strategy funds?
Yeah, so we never really used to invest in pass-through funds because we were always quite conscious about like what expenses are being passed through to the fund. But what we have realized is that there has been quite a shift, and that if you want to actually invest in these multi-strat funds, it's highly likely that you're going to have to go through a pass-through structure. So we talked about it collectively as a team, the investment team and the ODD team, and we sort of decided that if we want to go into a fund like this, if we want to bear that pass-through fee, it is a commercial decision, and we sort of need to look at what the net return is overall. So if we're comparing across managers, we need to be comfortable that the net return is what are within our expectations, regardless of whether we're paying a pass-through fee or a higher management fee, so that we're sort of looking at holistically. So we're looking in a slightly different way. And so what that's meant for us from an ODD standpoint is that our focus really is around the governance of pass-through models. So for us, it's very much understanding what expenses are actually charged through to the fund. Do they have like an expense allocation policy? If, for example, they have more than one fund, how is the pass-through being allocated across the funds, for example? And we had one interesting case recently where we had a manager that had a fund and also an SMA. And what we discovered as we were sort of going through the process was that although the administrator had visibility of the pass-through expenses for the fund, because the investor is managing the operational side of the SMA, the administrator didn't have visibility over the SMA. And so we were asking the manager to perform an internal audit whereby they would have the auditor look at the full, from the top down, what the total expenses were and what the allocation process was across the fund and the SMA to ensure that there was that level of independent oversight over that piece. So I think for us, primarily now, when we're looking at these structures, we're still sort of learning because it's very new. And I have to say, across our managers, no pass-through is the same. They're all very different. So there's varying degrees of what's being passed through and how it's being approached. But what we're trying to look at is independence throughout that, so we can get comfortable that what's being passed through is permitted to be passed through and it's accurate if there's multiple vehicles as well. So that's where we sort of landed on the ODD side with this.
Thank you, Nadia. Olga, anything to add here from your perspective?
Well, when I was looking at multi-strategy funds, pass-through was one of the main points that I had to evaluate, and it was looking at the arrangements with different pods, how their compensation structured. Is there a cap? Is there transparency? Is it net against the performance fee? Understanding what they do during the quarter, during the year, what transparency they provide to the investors. Do they manage their own teams? Is it small teams that just trade for that multi-strat fund? Is it a part of a different organization and they have other entities that they work with? And for the multi-strat funds, pass-through expenses was not the only issue. I haven't dealt with leverage that much, but what I found as well is when a manager uses a lot of external pods, how do they do operational diligence on those pods? And there was actually a point when I vetoed the fund because I didn't feel comfortable with the due diligence and oversight. And until they appointed someone to do proper due diligence on those external managers, we didn't approve the fund until that was done. So just also worth highlighting, and that's not the only issue that we might encounter.
Thank you, Matt. Anything to add here?
Yeah, so I think when I look at pass-through fees, obviously, as Nadia alluded to, you do drill down into making sure that those that are charged appropriately, and there is a commercial aspect to that. Although what I would say is that the paying of sign-on bonuses for new joiners, which is then passed through to the fund, is a way of getting around deferred compensation at a prior fund. So as a result, as an investor, you're actually paying for somebody else's performance in another fund as a result. So that actually then breaks down the whole aspect of deferred compensation and what it's there to do in terms of a talent retention tool. So that is something that we're quite conscious of, and we would tend to err away from, so to speak. I mean, generally speaking as well, when we do look at pass-through fees, we're very conscious of what expenses are being passed through, to the point where we will try and limit that to the degree that we can do so. Because I mean, if Joe Bloggs wants to go down to the local store and buy his lunch and that gets passed through the fund, I just don't see, obviously he's not getting paid enough, so maybe that's a cultural issue, or maybe that's just me being flippant. But you can see where the idea of it comes from. So it then does break down into a cultural issue as a result. I think on the leverage side, I think it's the managing of excessive leverage, especially in terms of how that's managed against the liquidity profile of the fund. Now, obviously, we've seen a lot of the larger multi-strats lock up capital for anywhere up to 5 years, so that becomes less of a problem for them. But as we start to see the cost of leverage increasing as the risk-free rate increases, and we start to see, we know that it's a low risk, high leverage strategy a lot of the time, we tend to be quite conscious of how they are able to meet those capital adequacy, the capital activity in terms of potential fund redemptions. But that's more of a problem for the smaller multi-strat managers, I would say.
Thank you. Eric, I'm going to turn to you.
Thank you. I was just noticing in some smaller multi-strats, they've had multiple classes where you can have locked-in fees, or you can go for the more fluid fees that would involve pass-through. And it's interesting to consider which one might be the safer bet, even though you may have less upside with the fixed fees, you do control your downside. That's a whole nother topic, but I was just curious, do you find many large multi-strats having those options, or is it only for the smaller ones that tend to have the optional classes, which are fixed?
I have to say, I haven't seen that yet, because I think that would create even more complexity.
Very good.
I have, yeah. I was going to say I have seen it, but again, it kind of goes back to Nadia's point in the beginning of looking at the difference, taking that commercial approach on gross versus net performance.
Very
when
good.
You're looking at it from a long-term perspective.
One of the things that I'm really proud of from the survey work that we've been doing for many years is that smaller funds often make this very tight list of the most consistent performers over the past 5 years. And a lot of people will defer from considering smaller funds because of headline risk and perhaps fear that you don't have other people who have done a great deal of due diligence into them. But I also think ODD by itself could help be somewhat of an equalizer in order to encourage allocators to perhaps consider smaller funds who have proven track records with solid long-term, well-established teams and processes in place. And I'm just wanting to ask each one of you whether you feel that ODD can be used in order to get folks into smaller funds and to expand their opportunity, even if they can't make the significant allocations that some allocators want to do with one ticket. It might improve their overall returns if they could consider these smaller funds. So, Olga, let me start with you.
I think smaller funds definitely have a place in the portfolio. It depends on the risk appetite, obviously, but ODD can have a look at the risks and highlight what's acceptable, what isn't. I work with small managers all the time. Most of the entities that I worked for had a portion allocated to, say, day one investments, a very early stage. And that's where I feel I can make the biggest difference, because I can go in and share the best practices. I can guide them towards service providers, policies, procedures. I think that's where ODD can make the most difference, because we can implement changes that will make it better. So I would definitely say if somebody has an intention to allocate to smaller managers, definitely the ODD.
And do you find that they might be more receptive to the recommendations, a smaller fund versus a larger fund?
A lot of smaller fund managers actively seek guidance and help, and they all very grateful. Not all, okay. Most of them are very grateful for feedback. They use it as free consulting. We see tens of funds every year. We maybe covered 500 or 600 funds during my career, and I know what institutional allocators are looking for. So they can definitely benefit from that review. And if they're not receptive, then that's a very good sign, and you shouldn't be allocating to them.
I was just about to say there's a connection to culture in what you just found. Nadia, any thoughts on that?
Yeah, I was just going to say that just want to disclose that at Kedge, we don't really tend to invest in the smaller managers, but I have invested in smaller managers in the past. And what I would say, it sort of probably depends how small we're talking, but my experience has been that there is that willingness to sort of engage with investors and definitely be responsive to feedback. And also, I think that they're also quite transparent and tend to be, there's less complexity in terms of establishing small managers because they don't have any sort of constraints with respect to like complicated legacy technology or systems. So they can start from fresh where they are in a point in time. So sometimes that makes it a bit cleaner. I think the difficulty that they have is if they are very small, it's sort of areas around like segregation of duties, expenses, sometimes sort of like service providers, and also sort of that working capital piece, because if there is an issue, unfortunately, that could impact them financially. That could be quite detrimental to their business versus if the same issue was to occur at a larger institution. So I think there's definitely strong advantages with the small businesses, but equally, I think they do need to be more conscious just because of that point where they are smaller. It is inherently a bit more risk attached.
Right. You hit upon an important. I'm sorry. You hit upon an important point. On my minimum survey, I would require at least 300 million. So we're not talking about tiny, large enough to have good service providers. So I should have qualified my question saying that would be the base, and that also they've been around for at least 5 years and they've established an audited track record. So I apologize for not laying out that groundwork first. But Matthew, knowing that, hopefully that will help you with your answer.
Well, actually, maybe we take a slightly more simple approach. Obviously, as a seeder of emerging managers ourselves, what we would generally tend to do is don't get me wrong, like all of the points that we've mentioned on the ODD side today are still pertinent to us making a decision on whether we invest or not. However, saying that, what we do need to appreciate is that the emerging manager is at a different life in the management company's life cycle. And I think it was Nadia that pointed out previously, what we want to see is we want to see kind of what the expectation is going forward. And so what we focus on more from the emerging manager side and from the seeding point, because we lock up our capital, is that we want to see the transition of how that business grows over time as AUM grows. We want to see the right decisions being made and those communicated. So in that regard, feedback is important. And I would always highlight that anyone that goes through an ODD process should ask for feedback. If it's not given, I mean, we openly are happy to give feedback on our decisions, or even not where we've passed a manager and we still think there is an element where it can be made better. Now, just because we've passed, and again, I think it was Olga that made this point, just because we've passed you in the sense of an ODD perspective, doesn't mean other managers will. So I think that you have to take any ODD decision with a pinch of salt as it applies to the rest of the community. Yes, we apply to similar standards, but we have different risk appetites. We may be capacity constrained in different ways, for example. So yes, I would caution that having a solid institutional investor on board for an emerging manager is very important, but it's not the be all and end all.
Let me just ask you if you could follow up. What would be the smallest fund besides emerging managers who may not have a lot to start with that you would consider at Investcorp-Tages?
I mean, it very much depends on the strategy as well. So, I mean, if you look at strategies that are more capacity constrained, so for example, we may be more inclined to look at commodity managers that are smaller, just because we know that where they will be in terms of their total capacity means that we have to get in early. So there are situations where that will drive a decision. But then what we would do is we would generally ask for capacity rights. We generally scale up our investment over time. as we reach towards that capacity.
Okay, very good. Linus?
I think we're actually getting close to the sort of the full hour here. So, Anna, do you see any questions from the audience that we should let in?
I actually have few basically same questions, so I'm gonna ask this as a one question. So the question from the audience is about technology and NI. So we talk about different complex issues in the ODD due diligence, and the audience is asking, can you think about technology or potentially using AI to help you identifying those complex issues? And Matt, let me start with you if you have.
Well, let's just start off quickly. I wish there was an AI tool that wrote my ODD reports for me, but I don't think one of those has come across yet. The problem is what we do is very subjective. So I don't think there's any chance of that happening anytime soon. What I will say, though, when we look at subjects like AI, I think we need to understand why AI is being implemented. And it doesn't get caught up into some kind of buzzword that's used for maybe potentially for marketing purposes. I've had a lot of marketing decks come across my desk where I've seen that AI, the managers themselves aren't actually using AI, but they're marketing it as if they are, and that will have great implications further down the line. Again, I think everyone's getting caught up in this concept of what AI is. I mean, I spent a lot of time with managers that do use AI properly, and or if they're using LLMs, for example, and we spent a lot of time talking about how they manage their data, and we look at how that, and again, it fits into the whole cybersecurity issue, which we haven't even really touched on today. But the IT and infrastructure side is I think, a bigger and bigger focus for the ODD community. I will go into the nitty-gritty of where your internet lines are run through, who provides them, what's your end-to-end point encryption. This is probably one of the areas that I spend the most time discussing is IT and infrastructure. And as AI gets drawn into that conversation, I think we're only going to see more and more of that over time.
Maybe we can have a separate webinar just talking about this.
I think you could easily fill an hour. Yeah.
Nadia, anything to add?
I was just going to say, just as Matt alluded to, I think the difficulty is around the judgment piece. So we started trialing an AI tool in-house, and I think for perhaps trying to start on the basis point of like comparing some documents, where there's been a difference between the two documents, or trying to help you kind of summarize paragraphs and kind of get the key points across, it can help, but it feels like it's still very, very early days, and we still need to do a lot of monitoring, and it just can't at the moment give us the judgment piece because it is very subjective. And so that part of it, we're very much still doing the old process. We haven't come across anything just yet that's really helping us to kind of do the bulk of the process, but I don't know if it will evolve massively over the next 2 years and we sort of see how it progresses. But as it stands today, we're very much involved in the whole process front to back.
Thank you. Olga, anything to add?
No, I agree with Matt and Nadia. I haven't seen any good tools that can help replace the due diligence process. There are certain tools that can help pull in some basic information, like scrub the internet for registration and so on. But that's just preparation for review, not the review itself. Because of the subjective nature and how different every manager is, it'd be difficult to do. And then AI cannot meet the manager and make that judgment. So I don't think you can ever eliminate humans from this process. I hope not.
Right? We don't have to worry about job security then. All right. Thank you so much. And I wish we had more time and could cover more questions. But thank you so much, the audience. And of course, thank you all, Nadia, Matt, and Olga, for your incredible expertise. And if we were not able to answer all the questions, but please feel free to reach any of us through LinkedIn if you have any questions you want to continue these discussions. And again, thank you so much and have a wonderful day. And Matt, we have a great next webinar about spending time on AI. Thank you so much, guys. Have a great one.
Thank you.
Thank you.
Thank you.
Bye-bye.
Thank you very much.
Bye.